Two Bowls in a China Shop is brought to you by these great companies that are giving us money to let you listen to their stuff.
Bullshit, Kyle. We make this show. You and me. Two Bulls in a China Shop is brought to you by us.
Someone's got to pay the bills, Dan, because it's not our trading.
All right, roll them.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face. Well, hello everybody and welcome back to the China Shop. I'm your host Kyle, and joining me for today's episode is our authentic and Australian acquaintance from across the Atlantic, Anthony Fatseas, anchor of the Audible WTFinance. How are you doing today, Anthony?
Yeah, I'm good, thanks. Can I steal that for my own intro? Is that possible?
Oh, yes, please.
How much will that cost?
Believe it or not, that's what actually got me out of bed this morning, was that alliteration streak. Like, how long can I make this? I think that's a record for the show.
Oh, really?
1, 2, 3,
oh, nice.
4, 5, 6, 7, 8.
Oh, yeah.
8 words? Yeah.
Lots of A's. I love it.
Pretty impressive. All right, before we dive into today's discussion, I'm just going to take a quick moment to say thank you to our sponsors and friends over at Manscaped, Trade Pro Academy, and Orderflow Labs. Manscaped is the best below-the-waist grooming with precision-engineered tools for your family jewels, and with the new improved 2.0 version of the Weed Whacker available, it's a perfect time to take advantage of our exclusive offer of 20% off and free worldwide shipping using promo code 2bulls at manscaped.com. As always, that is the number 2. And when it comes to institutional quality trading education, look no further than tradeproacademy.com. In our free Discord server, you'll find instructions to take advantage of our discount with them as well. And for all you degenerates who enjoy trading futures, you'll definitely want to check out the custom tools and studies over at Orderflow Labs. And if you're new to the show and haven't met Anthony yet, we'll have links to his YouTube channel so you can subscribe to WTFinance. That is WTFinance. You can thank us for introducing you to Anthony via our email at twobulls@financialineptitude.com, or you can just join that free Discord server where a bunch of amazing people gather to share our struggles and lessons learned with other like-minded market aficionados. Be sure to have all those links in the episode description. But now that we got all the BS out of the way, I know our sponsors love it when I refer to that as that. Let's just dive in. What's been going on with you, man? You got the new job that started?
Yep. So I got the new job, and then mainly just pumping out podcasts, trying to follow, probably similar to everyone else, trying to follow with what's happening in the world, which last few weeks has seemed pretty mental. And yeah.
I noticed your YouTube game has really been stepping up. The new cover art looks awesome.
Thanks. Yeah, I just basically steal images from everyone. So,
is it funny though how much of an impact that has on the like clicks that you get?
Yeah, it is like, and you have to look into that a bit more. So I've focused more on YouTube, and really the key things are the title and the click and the thumbnails, and also the guests as well.
Yeah.
So that's sort of what I've been trying to focus on. Whereas I think audio is a bit different.
You've been getting a lot of great guests too. I noticed you're talking to billionaires lately too. David Rubenstein on.
Yeah, I don't know why. They obviously don't see my podcast before they say yes.
I have the same thought every time I get somebody that reaches out to me. I had somebody, Kevin Davey, actually send me like all his books, like mailed them to me. I'm like, how the fuck did you get my mailing address? But okay, you want to talk to me that bad? Yeah, I'll talk to he's a rocket scientist and a 3-time investing champion. You want to talk to me?
If you're rich enough, you can get whatever you want, obviously.
Yes, I can be had for much cheaper than you think.
Don't need all the books for future guests.
Right. Really, just that you noticed. So what has the new job got you doing then?
Yeah, so I work for an energy company in London, and it's on the finance side. So it's quite interesting. It's like it's sort of like basically doing DCFs for buying companies, but also like their internal products that they sell.
DCF.
So it's like a discounted cash flow, which is like a way that you can sort of measure the value. But because it's an energy company, as you can probably imagine, and it's one of the biggest, and you can probably guess one of them if it's it's based in London. They were sort of spending ridiculous amounts of money recently, and now they're like, hang on, this probably won't last forever. Let's chill out a bit. So
Sweet.
yeah, there's more scrutiny in that regard. So it's just yeah, it's pretty interesting. I think it sort of expands to public stocks as well. So for anyone who's actually this is probably more longer term investing, then you have to do a DCF as well for oftentimes just to get the true value of the stock you're looking to invest in. So I think it's quite interesting. And public stocks are easier because you have all the information there, whereas if it's a private company, you have to try and figure it out on the go.
Yeah, and then you also have to, because if they're private, then there's a lot less regulatory controls on the information they give you too, right?
Yeah, exactly. And they're smaller, and then sometimes they're in different countries. So, for example, I was dealing with a company in Romania, which was interesting. So you can imagine there's lots of risks there. But yeah, it's keeping me busy along with the podcast.
What do they make in Romania? Gymnasts?
Gymnast. Is that the first thing that comes to your head?
I mean, that's where Vlad the Impaler was from, right?
Yeah. I think he was from Transylvania, wasn't he? But
Yeah, I've never visited, but I've heard some people still wish for his return.
yes, why wouldn't you?
I know, right?
Someone who kills lots of people.
Well, there's a lot of crazy people in Germany and Italy too. So
none in the US though, or UK.
yeah. Oh yeah. No, don't even get me started there. The fact that Trump is going to run again for 2024. Ugh.
Unless he gets arrested.
Dude, let it go. Let it go. We tried that once.
Yeah. Did you see that? How they're going to arrest him, apparently.
I saw that he said that.
Yeah.
But he also says a lot of things that I don't really listen to. So.
True. I think it's a good thing. A good thing to do is just ignore anything that politicians say, because it's just...
I know.
There's always a reason behind it.
Right. So what's been going on in your world then? You've been paying attention to this banking collapse?
Yeah, so a lot. It's just fascinating, isn't it? Like, it's something that hasn't happened for so long. So now you see something like SVB, one of the largest bank runs in history, going down, how quickly it occurred. And now we're seeing Credit Suisse, the same thing's happening there. That Credit Suisse is probably a bit more of a slow burner. Yeah, it's
Credit
like
Suisse has been burning for decades, it seems like.
Yeah, exactly. And I hear everyone saying like it's always been the worst run bank, and somehow it's kept surviving.
What did I call? I called them the North Korea of banking the other day. I think it's just terrible at being bad.
Yeah, exactly. But it's like, damn it, just die. But it looks like it's finally happening. And I don't know if you've, I think it's just recently announced that UBS, the other Swiss bank, is looking to put a $1 billion offer in, which I think is $999 million too much. But,
that was just announced this morning, wasn't it?
Yeah, I think recently. And to be honest, when everyone listens to this, it's probably going to be old and things are going to change, which is always the case.
We're recording this on the 19th of March, just in case anybody's curious.
Yeah, but I just think the numbers are ridiculous when you think about it. They've already been offered like a $50 billion loan. And if you think about that, that's close to 10% of Switzerland's GDP.
Right.
Which is crazy to think. And, we compare the numbers in the US and we say, 300 billion was added to the Fed balance sheet last week. But that's about 1% of the whole GDP. So,
right.
When you sort of comparing it to that, and that was over multiple banks, it's quite crazy. I guess the concentration in some European countries with these banks. So yeah, what could go wrong, mate?
Sorry, I had a burp there. I had to stifle. One of the things that really kind of shocked me was this rescue effort for First Republic that the major banks have all kicked in. Like, I don't know how, like four or five of the top banks have all kicked in like $5 billion each, and a bunch of other ones kicked in like anywhere from $2 to $1 billion.
Yeah.
What? Like, when your competitor goes out of business, normally that's a good thing for you.
Yeah.
Like the fact that all the major banks are getting scared enough to kick in their own money as uninsured deposits to save like one of their competitors. Like that. What is the alternative that they're scared of?
I think if for banking, it's probably not a good thing if your competitors go out of business, because then they're always concerned. There's always concern about contagion and what that means for everyone else. I think as well, there's a concern that will banks just become utilities where they can't do anything. All they can do is be like own well, even though they have owned treasuries, it's still had issues. But they can't like maybe invest in anything. Maybe they can only hold cash. Maybe they can only put it into the Feds. They have like a service where they'll pay you a tiny bit of interest every single month. So I feel like there's probably the concern from the big banks. Hang on, if all these banks collapse, there's going to be all this regulation brought in, and then we're not going to be able to continue with what we're doing and I guess make as much money as we are. And we're just going to become utilities that are very unprofitable, which I think I've heard was similar to what was happening in like the 60s and 70s, and then they transitioned with globalization, etc.
When was this? Is there any reference material that you can point to that because I'm not familiar with that. I kind of want to look into it.
About the periods back in the day.
Yeah.
I can look into it for you and get some stuff, and this is probably just me hearing someone say that, but if you think about, I guess, after the 70s, what really brought growth to the banking system was that globalization, was the increase in credit. I guess you could say CDOs as well were launched during that period, the financialization of the world, everything like that really is what grew the banking systems. In the UK, there was sort of the euro dollar system as well. But and I think back to your point, what you were saying, the issue was that. So one republic. Did I say one republic? What's the bank called?
First Republic.
not
close
the
enough.
Close enough. Yeah. They're not insolvent, and I think that's the key thing. They have a liquidity crisis, and they own all these treasuries and other bonds that, if they held to maturity, would mean they could pay everyone back.
Okay.
But the challenge is that because interest rates have gone up quite a lot, the value of those safe assets has decreased because obviously they're paying out less interest and they have less value. So the challenge is, if everyone starts pulling out their money, even if they sell all the current bonds that they have at the current price, it's not going to actually cover the difference.
Right. Okay. Right.
Yeah, which is so. But you could say they still have those assets there, and if they held them for the whole period of time that they until they expire, they would have that.
Yeah, but how long is that?
Yeah, and that's a challenge.
Right.
So it's really an issue of duration, which I'm not sure.
Isn't that similar to what happened to SVB before it collapsed? Like, weren't they just facing like a situation where they needed to do a little bit of fundraising? They sent out a letter to their investors, and everyone got spooked and just pulled all their cash out instead.
Yeah, basically. And then I think, but the challenge there as well is you have to look at the type of depositors. So yeah, and you've probably heard this talked about a lot, but retail depositors are normally going to have less than $200,000, or they're going to be below the limit, so they're not going to be as spooked because they're covered.
Yeah.
SVB had, I think it was like 90% or 95% of their depositors would not have been insured if there was a collapse. And they were very much more, I think, company deposits. So the concern there is there can be a bit of contagion. Obviously, Silicon Valley is very interconnected as well. It's sort of like an inbred place where everyone does everything. They're all together. So then, once someone gets spooked, they're all going to take their money out. It's a lot more flighty, the capital. And that's really what happened.
Yeah, especially since I think they cater to a lot of venture capitalists, and you got to imagine those people are going to be quick to pull the plug when something's not going their way.
Yeah, and it sounds like they did some dodgy stuff as well. Like one of them was one of the startups was complaining that they went to go put their money in JP Morgan, and they asked for an address, and they didn't have an address. So they're like, "Oh, this is BS. I didn't need an address at Silicon Valley Bank." I was like, "Well, that's probably an issue if they don't have like the KYC? They don't have those things in place."
Wait. Might have to explain that one a little bit more. Wait, they wanted to send their money to an account in JP Morgan, but they couldn't. Yep. They couldn't actually complete the transfer because they didn't know where to send it.
No, so they wanted to open a bank account.
Yeah,
they didn't have a address for the company.
Oh, yeah. Good Lord. Okay, yeah.
And then they were complaining that JP Morgan's like, "No, we don't want to take the money unless you have an address."
I see what you're saying. Okay.
Which you think it sort of makes sense. So
there's these homeless startups out there. Yes, I know San Francisco had a homeless problem, but I didn't know Silicon Valley was so bad.
Yeah, God, I didn't realize the housing prices were that high. If the startups can't do that. But yeah, so it sounds like there were some dodgy things. Obviously, as well, you could say they should have, sure, the Fed did pivot a bit quickly in was it 2021, start of
Mm-hmm.
2022 in terms of increasing interest rates. But then they sort of did tell everyone for the whole year that it was going to go up. So they should have hedged their interest rate risk. But I was
Right.
listening to a pretty interesting podcast today talking about they're actually, due to regulations, they're disincentivized to do that.
Really?
Yeah. So what happens is if they there's certain parts of the balance sheet that these assets go on. So let's say if you own a treasury, it's sort of off balance sheet. But if
Mm-hmm.
you were to hedge that, that would actually go directly into your P&L. So all the losses would go on your P&L. Yeah.
Oh.
So from their perspective, they're like, well, this is just going to make our performance look worse if we hedge it, despite the
I
fact
see.
that it's sort of offsetting the benefits that are coming from the bond. So then
Right.
so they were sort of disincentivized to do that. And from my understanding, that's different in Europe. So in Europe, they're sort of like, okay, you're hedging against this inflation risk. We're going to sort of pair it up with the bond that you're hedging that against.
Is that because the profits from the bond don't get realized until the asset is disposed of? So you're only seeing the effects of the hedge on the P&L sheet?
You could say that, but then you'd say there should be coupons coming in as well at certain
Yeah.
intervals. So you'd say that
Yeah.
the ideal way to do it would be they sort of cancel each other out, and there would still potentially be a bit of profit. But for some reason, and I don't know the specifics of it, that doesn't happen in the US. So
What was the name of the podcast?
so there was Macro Voices where they talked about it. There was also hang on, let me get it up. I just went for a long walk before this and
Oh,
listened to
sorry.
heaps
I
of
just want to
stuff.
put notes so we can link
The
it.
Macro Trading Floor, which is a really good one. So there are Alfonso Pecotilio and Andreas Steno, and they're more macro people. Link to
Awesome.
Blockworks as well, if anyone knows. But yeah, they were sort of talking about the intricacies behind why maybe these banks weren't actually hedging, which is interesting. But
Mm-hmm.
you should say, even if it does affect your balance sheet, you probably should have known the risks that involved, and they didn't worry about it.
Well, I mean, normally when you're putting a hedge on, it's to protect profits, it's not something you're looking to show profit from, right?
Yeah, exactly. And I guess the challenge was that these bonds, they weren't really making much profit because they did it a couple of years ago when the interest rates were so low. So yeah.
It's funny that you mentioned that because I just saw something that popped up the other day talking about the way the Fed's asset balance sheet has been working,
Mm.
and like we've just seen the money that the Fed usually kicks in because they usually make a lot of money from all these assets that they hold has actually shifted to where the majority of the members aren't kicking anything into the pot anymore. I think they only brought in 500 like 50 million this year or this last I don't know if that was the month of February. Whereas, like, 2 years ago, they're kicking in like $1 billion total. That goes directly towards the U.S. budget. So the effects of these rising interest rates combined with quantitative easing or no quantitative tightening is actually might have a direct impact on the amount of taxes the average person pays.
Yeah, it's interesting. I think it's probably not as big an issue as you think because they can just print all the money they want.
Right. Yeah, there's that too.
Yeah, so I think that's always the US is unique, and I guess you could say other countries can do this as well that have a currency. They can just no matter what the losses are, they can always print it. But I guess the US, they've also their currency is in the privileged position of being the world currency that most things are transacted in. So there's always going to be a bit of a demand for it.
Right.
And yeah, so
Do you think that's going to last much longer? It's been seeing like Saudi Arabia like now accepting the Chinese yuan for oil and
yeah.
uh, other countries that seem to have been like looking like they're trying to shift away from the dollar.
What do you think?
I don't know. Like the U.S. has been dominant for so long. You just got to think that the time in the sun is going to come down
Yeah.
soon. I've said before that I think that the U.S.'s unique political location, like being situated in the middle of like the trade between two continents, puts them in a unique spot. But I don't know.
Yeah, I agree with what you're saying. It's a lot easier when you don't have to fight all these wars against all the wars aren't on your doorstep. You have a heap of energy. You've got
But also having easy access to two major oceans.
yeah, true. Both Asia and Europe and
Yeah.
Africa.
Yep.
Yeah,
That puts us smack in the middle. When Europe was, at its heyday, that was before they were sailing across the other side of the world. They had to go around, Africa to get to India.
mm. Yeah, and I think it's all relative at the end of the day. So if you compare the currencies, and I've got a few trades on in currencies at the moment, it's just like, okay, maybe the US will depreciate against certain products, but will they depreciate against other currencies? And
Mm-hmm.
I'd say probably not. There's an interesting guy called Brent Donnelly, and he talks about the milkshake theory, which is where
Oh, is this from the what was that movie? The guy drinks his milkshake. There will be blood.
I'm not too sure where it's from. Maybe explain this milkshake. I like it from the movie.
Oh no, that's the guy is bitching or yelling at his son, his adopted son. The guy was trying to sell him some oil land. He's like, I bought the land next to it. I drink your milkshake. He's like tunneled underneath and is like sucking his oil reserves dry from.
Yeah.
But yeah, the whole thing was
That's
about
classic
drinking his
America, isn't
milkshake.
it?
Yeah.
Yeah. No, it's interesting. Well, yeah, I think it's sort of just saying that I guess a lot of the, especially during times of crisis, a lot of the capital it normally goes to the US just because it's the biggest
Mm-hmm.
country. And there's also other factors as well why, if we look at current monetary policy, it's got high interest rates than most. And why can the country potentially handle higher interest rates than most? If we compare it to and sorry, this is probably going a bit off tangent.
No, go for it.
But if you can compare it to like Canada, Australia, or the UK,
Mm-hmm.
those are countries that with mortgages, they're sort of variable rates. So
Yeah, it's so weird, isn't it?
yeah, which is but it's funny because it's not weird for those countries
Right.
because it's sort of what they've experienced. And if you think about the last 30 years, it's really benefited mortgage holders because
Yeah.
interest rates have gone down. So, or you could say even 40 years. So if you had you bought a house 10 years ago, you have let's say interest rates are at 3%, 5 years later, they've probably gone down to 2%.
Mm-hmm.
So you're actually paying less. But it's only now that interest rates have increased
Right.
where that's going to be a major issue. But what does that mean for monetary policy? So lots of people's mortgages are going to roll over. They're going to be paying a lot more.
Mm-hmm.
So someone I interviewed recently said they knew someone in the UK whose mortgage repayments were going to go from £1,500 a month to 5,000.
Oh,
Which yeah, so
wow.
it's a lot higher, over three times the payments. But that's going to have a massive impact on inflation because it's going to reduce the amount of capital that's being spent in the markets. You could say it's also going to reduce the sort of the housing markets, but it's actually going to have an impact on the bottom line.
Mm-hmm.
So central banks have a limitation of what they can raise interest rates for to not crash the property markets, but also it's going to potentially bring down inflation even faster.
Well, whatever their controls are, it's not enough to stop you from 3x on your payment from one year to the next. Like,
well, I don't mind if it brings property houses prices down. I'm happy for that. I need to get on the property ladder.
oh yeah, you guys need that in England.
Yeah, especially near London. And you could say that might not happen in London,
Mm-hmm.
but yeah, as we say in the US, because you're locked in for 30 years, there's not going to be that sort of sucking out of capital from the markets because people
Right.
are going to be paying that forever and ever. But then
No, but what the impact that does have is actually on the secondary loan market. So a lot of these mortgage companies, they underwrite the loans, but then they turn around and they sell it to another,
yeah,
bigger player to hold it. But now nobody's paying for any of these because nobody thinks these interest rates are going to last. So nobody's paying any premiums on this anymore.
and then that's a shadow bank. It's shadow banking system. So there's people who hold these, and a lot of them are like money market funds, MBS funds. They hold these. I think they're MBS or
mortgage-backed securities.
Yeah, exactly.
Yeah.
They hold these, and they're government backed. But the challenge will be if people start withdrawing their money from these funds, like we saw from the banks, they're not going to have it all. They're not going to have the money there, which is really concerning, especially if there's not more. Let's say sales dry up because there's higher interest rates, so people just hold on to their houses for longer. They don't move. There's going to be less of that sort of securities in the market. So yeah, there's going to be more loss for longer, which is crazy to think.
How many countries have a variable interest rate system, like you mentioned? You mentioned Canada and UK.
Yeah.
Like who else has this system?
So from what I know, the big three are Canada, UK, and Australia, and they're probably the ones also with the largest property bubbles. So if you look at it like London's one of the biggest bubbles. Toronto, Vancouver, Sydney, Melbourne, they've all got these massive bubbles where properties are just ridiculous. I know people who in Australia who bought like not really big like maybe a house, like 3 bedrooms, pretty not hardly any yard, over 2 million Australian dollars, which is what 1,500 US,
Wow.
1.5 million US dollars.
Yeah.
It's just, and they're not right in the city. They're not in the best locations. It's just unsustainable. So
Mhm.
those are the big countries. I know some people in Europe, and I don't think they're, from what I've seen, the Netherlands, they sort of a 10-year variable, so
Mhm.
it's probably not going to be as much of an issue on them. I think other countries are similar to them, but really, yeah, those three are sort of going to be the big ones that probably won't be able to increase interest rates as high. That inflation will go lower. So then, what you compare is, well, the US dollar is probably going to appreciate higher against those currencies because the interest rate is going to be higher. There's going to be capital flows going into the US to get that higher yields compared to the other countries.
Yeah, that's one thing that the U.S. does benefit from when inflation gets higher, or when the power of the dollar gets weaker, is that we get a lot more exports going because your guys' money goes a lot farther here.
Yeah, exactly. But what I'm saying is that so the US dollar will increase in value.
Oh, you're saying it's the opposite way.
Yeah, because
Oh, fuck me. No, that's not good.
well, yeah. Why would someone hold one Canadian dollar if it's only giving you 3%, uh, you know,
Yeah.
repayments when you can hold a US dollar that's giving you 5%?
Right,
Yeah,
right, right. Oh shit. Yeah, that's mm-hmm.
and especially if you think of like who are the major capital, where's the major capital flows come from? It probably doesn't come from the individual person. It's from the big institutions, pension funds,
Right.
hedge funds. So they're really, Japan's well known to have trillions and trillions of dollars in pension funds that's always going between the US and Japan.
Mm-hmm.
So they're going to have that search for the best yield they can get. They're
Right.
going to go to the US, which is going to increase the value of the US. And if there's a crisis as well, the US is known as a safe haven, so it's going to further
Right.
move to the US. So yeah, I think we could see a really strong dollar at least in the next 6 to 12 months.
Oh shit. I gotta have to look and see.
Which
So hear you say you had some currency trades on?
Yeah, so I've got just once. I've just got a long US dollar versus Canadian dollar. Really, for the what I was saying before
Mm-hmm.
about they can hold it higher for longer. Obviously, there's a risk that Power will this week will counter everything I've said, and he'll be like, "Nah, screw it. We're gonna keep interest rates the same." Or I think if he increases it by 25 basis points, which probably most people expect, it
Yeah.
shouldn't affect the trade as much.
Do you use
But
the FedWatch tool where you can look at the real time pricing predictions based on the Fed funds rates?
no, I haven't used that one. Where are we at?
Let me pull it up.
What are your thoughts on this? I feel like I've just been ranting on for ages.
About whether or not we raise or
Yeah,
hold. Percentages have been bouncing between 60 and 50-50 for a pause, or actually as high as 80% for 25 bip. It's fucking really crazy to use this tool and watch it like change on the daily.
yeah,
Here, I'll post you a link so you can take a look at it. Like a week ago, we were 60% 25 bips, 40% 50 bip hike, and then today it's 38% no change and 62% 25 bip.
yeah. So, what do you think would be the hypothesis behind them not?
I think if they don't, it's because they're afraid that they've pushed it too far too fast and have already started breaking the banking system.
Yeah,
I think there's that, and then there's also the question of whether they want to give more time for the changes they've already put in place to start to let some of those lagging indicators show what's actually happening.
yeah. Is that? Do you think that would, or what do you think will happen?
Well, from the research I've done, it seems like a lot of the stuff they do, it takes 6 to 12 months for any of the effects to actually show up. So, I mean, we just started raising rates aggressively and like 12 months ago.
Mm,
I think it's been, yeah, I think the first one was sometime in March of last year.
yeah,
So we should just now starting to see like how the effects have been, uh, like what sort of changes those effects have been doing. So I guess it's really going to depend on how the inflation numbers and everything else continue to come out.
yeah,
If they show signs of turning over, and if the hot print that we had in January was an anomaly, or if it's going to be more of the trend.
yeah. And I feel like if we look at Powell and the Fed's actions over the past year,
Mm-hmm.
the one thing that he is most concerned about, in my opinion, is that he would be seen as another Arthur Burns, who was the Fed chair in the 70s, who was really blamed a lot of the time for inflation getting out of control and Volcker having to come in.
Well, he didn't help his case by sitting on his hands for the first year when everybody knew inflation was going to be a problem.
Yeah, exactly. But I guess you could say as well, and this is maybe me being the
Devil's advocate?
yes, exactly.
Yeah, you can do that.
Uh,
We encourage that.
that when you haven't had inflation for 10 years,
Mm-hmm.
you do let it run a little bit. But then I agree that he was far too slow to change what was happening. But I think as well is that he understands that he screwed up already. He screwed up on that first call. He took too long to increase. So now it's like, well, if he decreases too quickly, or if he slows down too quickly, that's going to potentially have the risk of inflation coming up again. And then he would be an Arthur Burns, because if we look at how it worked in the 70s, it sort of decreased a little bit. The Fed sort of cut back a little bit as well, and then it went up to its highs after that. So there was sort of like
I see.
a little bit down, and then it went further up. So the concern is that if he cuts a little bit, and even if they don't increase at all, I feel like that's even a bigger message, as you said, that it will show you that the Fed are concerned. And I think that could have even a bigger impact on bank runs throughout regional banks across the US, because then it's like, oh shit, he has all the data. Things must be pretty bad if he hasn't increased after saying he's going to, and after I think he had the recent I don't know if it was congressional hearing, or he was talking to sort of politicians, and he was saying that we're willing to increase further and further. We probably should have increased further last time. So
yeah, but that was before SVB, wasn't it?
Yeah. But then I guess you could say as well that what would decreasing interest rates do to that? Maybe it would increase the value of the bonds that they hold on the balance sheet. But they've already brought in that new scheme to which aims to sort of give the banks liquidity on these assets. So if there is a bank run, they're okay. Which is basically, you can, I don't know if you've heard of this, FDIC, or I'm not sure what it's called. But basically what they do is that you can give the Federal Reserve the bond that you have. Obviously it has to be a Fed or a MBS, a government-backed bond. It might be 80 cents on the dollar value at the moment. They will give you for the value that you bought it for. So they will give you 100 cents on the dollar for
something that's worth 20% less.
Exactly. So basically, that what they've done is, rather than doing, you could say, like, it's a classic analogy that the interest rates is like a sledgehammer on the economy.
If you haven't heard by now, Manscaped now sells beard products. That's right. Once again, revolutionizing men's grooming with the brand new Beard Hedger Pro Kit. From a beard trim to a fresh shave, the technology behind the Beard Hedger Pro Kit allows you to shape your signature beard look. Now you can finally use Manscaped products to make your drapes match your carpet by going to manscaped.com and using code 2bulls for 20% off and free shipping. God damn, I was going to make that joke. Our friends over at Manscaped were kind enough to send me the Beard Hedger Pro Kit, and I gotta say, I was impressed with the quality and performance of the products. My thick, coarse beard hair has been giving me trouble with trimmers in the past, but the Beard Hedger was able to cut through the thicket without any tugging or discomfort at all. And because the trimmer has one rotary wheel with 20 length settings with only one guard, I don't have to worry about losing or breaking attachments anymore. So I've tamed my mane, and now you can too. No one likes a weird beard, so say goodbye to your stubble trouble with Manscaped's Pro Beard Kit. It all starts with that beard hedger that I mentioned. The thing's a juggernaut of fixing faces. Not only does it have the trimmer with the rotary wheel that gives you the 20 hair cutting lengths on just the one guard, it's also waterproof, so you can shave in the shower and avoid all the hair in the sink. The titanium coated T-blade is tough on hair but smooth on your face, leading to a single stroke efficiency that brings satisfaction one stroke at a time. Phrasing. The Pro Kit doesn't end there though. They also created 4 dermatologist tested formulations for your post-trim care. First is the beard shampoo and conditioner. Gotta remember that all your hair is different. Beard hair, as I mentioned, is more coarse and easier to damage than the hair on your head, if you have hair on your head. That's why the kit has made shampoo and conditioner specially designed to moisturize, reduce ingrown hairs, replace natural oils, and promote beard health. Next, the kit has Manscaped's Beard Oil, an essential piece for your main facial accessory. No one wants a guy whose beard is brittle and dry. The oil relieves dryness both on the beard and the skin beneath while adding a little shimmer and shine, which makes you look extra fine. Cap off the kit with the Beard Balm, a pomade that shapes, styles, moisturizes, and tames for a sculpted look to attract any fellows or dames. The Pro Beard Kit also comes with 3 free gifts: beard brush, comb, and scissors to ensure your beard is ready to impress. So get 20% off and free shipping with code 2bulls at manscaped.com. Of course, that's the number 2. That's 20% off with free shipping at manscaped.com using code 2bulls. Manscaped Beard Hedger, 1 stroke, 1 guard, 20 lengths. Is that why we saw the spike in the Fed's asset balance sheet? Is that
Yes, exactly.
I was trying to figure out where that came from because I was wondering if did quantitative tightening suddenly end this week?
No, so I think that's that. I'm pretty sure, and I'm not an expert on this, so I might be wrong, but I'm pretty sure that's
I'm not at all either.
yeah. If you think we're experts, stop listening
yes. Buckle up because you're going to get a lot of bad information.
From the financial ineptitude individuals.
Yes, exactly.
But yes, I think that's where it's all come from. So these banks have decided to, and it could be just be from a risk prevention mechanism.
Mm-hmm.
But basically, what they've done is they've swapped those loans, those bonds, for a loan of cash, basically. And from what I understand, it's for a year. So that I think the hypothesis behind that as well, in a year's time, interest rates, inflation will be down, hopefully. Interest rates maybe will decrease. The value of those bonds will be at a higher rate. Or it also gives you time to maybe hold them till maturity, and then you get paid out everything.
You said that, and I've heard many people talk about that, like when inflation comes down. Like, what happens if it doesn't?
I don't think it will, but I think the Fed are hoping.
I don't think it will either, but I mean, that's there's a lot of people making a lot of plans based on it coming down.
Yeah. Well, I think that, yeah, I agree. And someone I recently interviewed, his name's Michael Cow. He was saying that he thinks that we're in a new secular shift where inflation will be higher for longer.
Kind of like a return to the 80s.
Yeah, sort of. And I think people have been comparing it to the 40s as well. So there's sort of different trends of what's causing it. But yeah, it will be quite similar where there's all these macroeconomic trends in the background that are going to influence this, as well as you could link it to the 70s in terms of, the 70s was quite, I guess, politically center left. There was lots of money flowing around, lots of incentives. So what can a central bank do when the deficit is so high during such a period? If the government just
print more,
if the government just gives out 3 billion or 3 trillion, every year on top of what they're already doing,
right?
What will interest rates do? There's going to be so much more money in the economy. We've seen these investments in green energy and semiconductors, all this stuff. I think that's probably going to continue into other strategic industries that they want to improve, obviously with this China-US sort of proxy war. So all that's going to cost money. All that's going to put pressure on supply chains. We already know there's shortages of commodities throughout the world, let alone if every country does this. Probably going to be bad for inflation, and people are just hoping that things go back to the good old days, and I hope that happens, but
I hope so too.
Confident.
But I've noticed whenever I hope for my stock positions to go back to the good old times when they were up higher, it usually ends up not working out for me very well.
Are you the inverse indicator, basically?
Yes. sometimes, yes.
We all feel that way, don't we?
I know, right?
Well, I've got another short on Nasdaq, which hasn't performed very well because, and you could say maybe I've short. I was thinking the markets go down. I chose Nasdaq because I thought higher beta would probably have more volatile move. But then you have to look at what are the companies that are actually in that index, and the ones that have gone down a lot. Banks obviously Nasdaq has no exposure to that. So
Nasdaq but you should be good with betting on the Nasdaq to drop when interest rates are going up.
You think so? And so it's probably only a shorter one. So I'm a little bit in the red at the moment, but because it's just the large move we saw last week. But we'll see what happens.
Were you trading when we were talking before? Because I don't remember having discussions about actual trades you're putting on.
I don't think so. I think it's only just recently been getting back into it, to be honest. And I don't know how good an idea that was, but I've always had the challenge. Like I feel like I pick these good trends and then I hold on to them, and then some of them get into pretty good profit. So for example, I had a long in oil start of the year where it went from sort of 75 So let's say Brent. So I had a long on Brent, which Brent oil, which is sort of the world oil outside of the US.
Yeah.
Went from 79 to sort of like 89. Did really well.
Yeah.
But I'm like, oh, there's a bit of a pullback. I'm going to hold on to it till it goes back higher. Didn't go back higher. Sort of gave away all my gains. Close to 1,000 points.
Right.
Which is always been my challenge. It's like looking too far ahead and hoping for too much of a gain. When sometimes it's like, far out, mate. You've done pretty well. You've got a good profit. Yeah.
Yeah, that's one of the things that it took us a long time to learn. It took me a long time to learn is you got to pay yourself at some point.
Yeah, exactly. And then I think as well the challenge was that I was at the minimum amount that you could actually, like the minimum position. So then
are you trading futures or
no? It was just you can they call it spread betting over here in the UK, which is basically means that you don't actually own the asset. You're betting on the movement of the price.
Okay.
Which is a tax. It's for tax purposes. So because it's betting, you don't actually pay any tax on any gains. It's not capital gains.
What?
Yeah.
Oh, because you don't. Okay.
Well, because you don't own the asset.
Yeah.
You're only betting on the movement of the price. And in the UK, you don't pay anything on betting wins. So basically, rather than buying an option or anything, you just say if you think it's going to go up or down, and then you'll get. It's similar to what happens. So if you think if you short a stock, someone has to sell a stock somewhere, and then you buy at a lower price and get the difference. Or if you long the stock, the same thing. Yeah, but yeah, I think it's and I don't know how long this will last. Probably surprise it's gone so far long already. But you are limited on what you can do. So it's mainly indexes and sort of commodities and stuff. So you can't do this on all companies from what I've seen. But yeah, it is an interesting way to get exposure.
Been playing around with any stocks?
Yeah, or even just I'm not so nuanced on options either, or futures or anything like that. So I don't know. I think that's what you guys focus on, isn't it?
Yeah, I've been spending. It's been like every day for the last. Oh God, I don't know now. 2 years now. It seems like. Getting there though. Yeah, there's been a lot of people helping out in the Discord, sharing a lot of great information. Purdue's been super helpful for my journey, but I'm in the middle of trying to pass a prop account evaluation right now. Actually have one in the green at the moment, so definitely trending in the right direction for the first time in forever, it seems like.
Yeah, nice, awesome stuff. And are you sort of just from what I've seen, it's daily trading, very much, day trading.
Yeah. I'm trading mostly on a 5-minute chart pattern. I look for like flag pattern breakouts or
Do they call that like the crack?
The crack. I think the crack is like the scalping, like when you're looking for those little 5-point moves on like your trades last for seconds. Like, oh, click here, out, 10 points. Nice. Do it again. Do it again. Do it again. Do it again.
As someone who's more of a swing trader, I think I call it the crack time frames.
It's funny like that. I think of because I used to be on those crack time frames like that, and then when I started getting better success when I shifted to a longer time frame using the 5-minute chart, and like holding for what feels more like a swing for like on the day time frame. I'll hold trades for 2 to 4 hours sometimes.
Yeah, I'm holding trades for weeks sometimes.
Yes.
It's just what you used to. Yeah,
I still do some of those though. I like to, every now and then I'll sell some covered calls on some positions that I own, or take some lotto swings on, a company that's got earnings coming up in a month that I think is going to do strong.
Yeah, nice, interesting to see.
Yeah, it's been a grind, but finally starting to see some of it pay off.
Yeah, well, I'm assuming that volatility probably helps your strategy.
I actually don't like it as much.
You don't like it?
No, because then my stops start getting wider, and then I can.
True. Would you reduce your position size then?
My size is based on the risk for the trade, so I allow myself $150 to $200 per position, and the stop size is what then determines how many contracts I can purchase.
Yeah, okay.
So if I got a 10-point stop, then obviously I can only have three to four contracts.
And what would your average stop be?
Seems like it goes from as high as 12 points to as low as 3. Really just depends on the candle that initiates the trade.
Yeah. And then your risk reward, like what would you do your risk reward?
2 to 1 for the first 2/3, and then runner goes to 4R.
Yeah, interesting.
Yeah, once I put the structure in place like that, it makes it a lot more automatic and I don't have to think about it. It's something that I have to work on finishing this week is figuring out how to handle trades that get close to take profits, but not quite. Because that's been my Achilles heel this week. Those ones that like tickle your take profit, but then come back and reverse on you.
Yeah, yeah.
It's nothing worse than seeing, oh fuck, I just had a
It's better just removing yourself from as much as possible.
that has been the key. Yes. I take as much of my decision making out of the process as possible.
Not judging on your decision making, but I just know for myself that yeah, I'm not very good in those
My
situations.
just no, because it's so hard to separate yourself from those emotions, the
Yeah,
greed and the fear. They make you do irrational things, and if you don't have a plan in place for how you're going to act when those scenarios start to play out, then you're just going to either do something rash and stupid, or you're going to be inactive and not take any action. And both of those situations can be just as painful financially.
yeah. And my definite go to in life in general is doing something rash and stupid. So it's always good to just yeah, ask anyone I know. So,
Fair
it's not
enough.
good as long as money is not involved. It's you can sometimes do that.
Right, right. Oh shit. Oh, there was one other thing I wanted to ask you about. If
Yeah,
you were listening to Yellen's comments about the signature bailout, that they not bailout,
yeah.
but basically the not sorry, not signature. It's SVB. It was the raising of the FDIC limits to make all the depositors whole.
I feel like she is one of the worst public speakers I've ever watched. how, how she was sort of Fed chair, and I guess you could say maybe there weren't too many volatile events during her reign.
Mhm.
But it's scary to think that she was Fed chair, and maybe things have changed. What is she 70 or something, and she's still got her.
Maybe she just doesn't care anymore.
Yeah, maybe she's like, oh, I'm sick of this shit. But
Well, it was the comment that I saw that kind of shocked me a little bit was that I think it was the senator from Oklahoma
yeah,
asking about what happens if a regional bank goes down. Are they going to get the same treatment that SVB did? The reply or the answer to that was no. Like, oh, so wait, are you saying there's different rules for bigger banks? Because now you're starting to incentivize consumers to put their money into banks that are too big to fail.
yeah. And the crazy thing is that if you look at SVB, like the CEO was actually he was lobbying
Hmm.
that the bank didn't have to go didn't have to do sort of stress tests because they weren't big enough and they weren't important enough.
Oh,
He
really?
lobbied the Feds and the Treasury to say that, and now they've
Oh,
collapsed, and the Fed have
oops.
come in and they've basically guaranteed all deposits. Which is, as you said, this would not happen in any other bank. It's just ridiculous how. And it's this classic like class divide, you could say, and you can bring that into it, and I think that is the case. Like you look at was it the governor of California had like $6 million in there or in SVB or something like that, and he was one of the people who was lobbying
Oh,
as well
really?
to make So there's and he was lobbying to make sure that everything was supported by the Fed,
Of course.
and he was also and he didn't actually tell them that he had money in there. There's just so many of these things. Like I don't know how these people get away with some of the stuff they do. It's just
Well, the other thing that's a little strange too is all the Chinese companies that are going to be getting made whole too, because there's a lot of Communist Party backed entities that
yeah.
had money in SVP that are going to get their deposits made whole.
And she said that she's like, yeah,
Yeah.
that's going to be the case,
Yep.
and it's just ridiculous. And like as well, you can be in the same bank, but you can have different bank accounts, and each of those different bank accounts is covered separately. So you can have
Yes.
200. So like basically, this whole system does not make any sense whatsoever.
It does not. No. No, I've been trying to figure that out. Like, what is the difference between having multiple accounts below the threshold versus having it all in one?
Yeah, and then if you look at the FDIC, and I guess maybe what they're saying is, oh, that they are, they're a solvent. You could say they've still got enough. They
Hmm.
would have enough money to pay out all the depositors. It's just that they have a liquidity issue. You could maybe say that, but the challenge is the FDIC. From what I know, they only have like $200 billion that they can actually use to support these banks. You think about all
Hmm.
the regional banks and every single bank in the US, it's tens of trillions of
Right.
deposits that they have. So what will
Yeah.
200 billion do to sort of solve all these, to help all these banks if there were to be an overall massive bank crisis? It can't do anything. It's
Not going to be enough. No.
literally, and it's just like, it's a classic, like, yeah. Some people get supported, some people don't. As you said, like the guy from Oklahoma is basically saying, well, what you're saying is you're supporting a run on every single regional bank in the US.
Yeah.
You're saying,
Yeah.
well, screw that. Why would I bank with a small bank who, if they go bankrupt, I'm going to take a haircut or I might lose everything? I should go to JP
Mhm.
Morgan, to Morgan Stanley, to these bigger banks within the US, because I know that if they were to go under, I'm going to be covered completely.
They're too big to fail.
Literally, it's like, and I think she was, it was such a horrible way that she presented it.
I know.
She was suggesting what he said, that people should
Yeah.
run on regional banks, which is
Yep. You should take all your money out of the regional banks and go to the big banks.
yeah. So I really think that Jay Powell has to come out and say something about that in this FOMC meeting.
Oh, that'll be really interesting to listen for.
Yeah, he'll have to, because I reckon there'll be questions about that.
Yeah.
Probably linking to Janet Yellen's comments, because
Do you think he's sitting at home cursing? You're like, why the fuck did you just say that?
literally he's just like, for fuck's sake, I do my speeches for hours and hours. I try and make sure people think that everything's okay, and now you've just gone there and said, yep, take your money out of regional banks if you have more than 250K.
Yeah. And also, we're going to screw Americans. We're going to pay back the Chinese.
Yeah. Yeah. It's not a good look. And I think
No.
it's scary to think what will happen. And the challenge as well is it's not just, there's not just duration risk. There's other, as we mentioned, there's more MBS risk as well for some banks. Some banks are very concentrated in the assets they own. So there could be risks there that if they have to sell everything, that there won't be a liquidity pool to sort of help them out. So I think this could get worse in the short term. I would be careful about shorting some banks, though. I know, if you look at Silvergate or all those other banks, a lot of them have already come down, Credit Suisse, a lot of them have already come down 90 to 95%.
Right.
Do you really need any more? Do you really need any more? Or do you really think that, they're going to come down further, maybe an extra little bit, but there's the risk that, especially if they're smaller in size, that meme stock, traders come in, they're going to absolutely push it up. They're going to cause you to have margin calls.
Also, then you also have the thing that you're seeing with like Bank of America and the inflows that these big banks are seeing because of the fear of the regional banks. Like some of the big banks are probably going to do pretty well during this whole thing.
Yeah, but then I think if you look at the long term, it's like linking back to what we said before. Will they just become utilities? Will they be allowed to do all the stuff they've done in the past that's made them lots of money? Or will they just be, you could say as well, they're going to have to pay probably higher, but maybe they don't have to actually.
I just can't see the banking industry not having enough power to fight that.
Yeah, but then, what I was saying then is maybe they'll have to pay higher sort of deposit rates to get people in. But why would the big banks do that if they're apparently 100% insured by the government? They have no incentive to pay anyone a higher deposit rates, that interest on their deposits.
There used to be a time when you get 5% on your money at a bank.
Yeah, and I've seen some of it come back. So like some of the banks over here are like 3% or so.
Oh, really? Majority of ours are like 0.01%.
So it hasn't gone up at all.
Not that I've noticed, but I haven't looked in a while.
But then, and now it's like you could say that interest rates are up. Why would banks have to offer any? Why would those big banks have to offer any increases? They won't, because they know that people are going to put their money in there.
They're getting the money already. Yeah.
Well, yeah, they're 100% insured, whereas the smaller banks might have to do that. So
yeah,
it'll be interesting to see what happens. I think, and I was listening to Steve Baum from The Big Short. He was talking and he was saying that they're always looking to fight the last war, like with everything they do. So like most of the tests, most of the sort of stress tests and everything like that was looking at credit risk. But now we've seen that the issue was,
I gotcha.
Yeah, so even if SVB was covered by this stress test, or these other banks were covered by them, it might not even come up, because it was a different issue now. So
right,
yeah.
Didn't I also see too that the CEO and some other insiders were unloading their shares about 2 weeks or so before the collapse?
Oh, there's so much shit. Like it's like how there's so many conflicts of interest. How could you, as a normal, as a sane person, and maybe that's the issue there, or like as a good person, be like, well, my bank is fucked. Everyone's leaving. Let me just sell my shares. Let me make sure that I'm getting my money out just to make
Right.
sure I'm whole. It's just. And I that's the one thing I struggle with in terms of these bailouts is that I'm a pretty strong capitalist. I am I support this sort of I support sort of free enterprise and whatnot. But if you screw up and if your screw up affects lots of people, you shouldn't be bailed out.
No.
Those people should be bailed out. You should get screwed, which is doesn't happen, which is always an issue.
No. The whole point of capitalism is that you succeed on the strengths of your own merits, not government backing.
Yeah.
And if the problem is that things are too big to fail, then maybe we should be looking at breaking these things up.
But SVB wasn't too big to fail. That's the issue.
I know. It was only the 16th largest bank.
Yeah, and you could say it's the largest that's ever, or second largest ever.
Second largest, yeah.
Lehman's, yeah.
Washington Mutual was the largest.
Oh yeah, okay, but yeah, it's only going to affect a small portion, and even then, you could say, okay, I guess you could say you have to protect the depositors. That makes sense, but then,
yeah,
if you're doing it for them, you have to do it for everyone. But I guess that's where they brought this new facility around to hopefully prevent it from happening in the future.
Well, it'll prevent the exact circumstances that led to SVB.
Yeah.
But not the next circumstances that'll lead to the next collapse, from what it sounds like.
Yeah, exactly. Which is, it's just the issue of banking, and that's why I said it's like they're trying to always push as much margin as they can to get back to the glory days, I guess pre-2008, where they were just raking it in. Their stock prices were so much higher.
Yeah, back when due diligence was optional.
Yeah, exactly. And this is not even talking about European banks. I think there's a few European banks as well, which might, other than Credit Suisse, which might be struggling.
Credit Suisse or HSBC is the other one that I love to hate.
Hey, I've got money there. Careful.
Do you? Oh.
Why do you hate them?
Oh, the money laundering from trash bins being brought in. Yeah,
in Mexico, was it?
Did you listen to? Or you talked to Ian Fraser, right?
Yeah. I talked to him, and I also did an interview with someone else who actually recorded it as well, Leonard.
Oh, there's somebody else we talked to about HSBC. Yeah, HSBC is like that's what Credit Suisse hopes to be.
Well, they've made a few fuck ups recently, but
yeah, quite a few. Not as bad as the Royal Bank of Scotland or Iceland.
Yeah, exactly. Well, Credit Suisse could be sort of, because if you think about it, if $50 billion doesn't mean, and you still have to sell, that's pretty fucked up.
You get, but you're also selling for $1 billion after you just got a 50 billion infusion.
But it just shows you how much, like, they could be, and they have trillions of dollars under management, I'm pretty sure. So it could be.
Oh, Jesus.
Could it be worse than the whole of the Swiss GDP?
Wow.
But that was, Iceland was like that, wasn't it? Iceland was worse.
Yeah, exactly. Yeah.
I guess we'd never, if it happened to Switzerland, we would have never seen anything on the scale of that type of country.
Oh, man.
This is, yeah.
I'm just trying to think of what the ramifications, especially a country that's known for its, wait, you say Switzerland or Sweden?
Yeah, Switzerland.
Switzerland. Yeah, the country that's known for banking and neutrality. Like, if they fuck it up, like, oh, fuck, I'd be terrified.
Literally. And then it's like, well, and I think if that were the case, we would see a massive run on almost all banks.
Every bank. Yeah. Oh, yeah, 100%.
Yeah. Anyway, all good. So what do we get along next week?
Yeah, anything positive you want to end us with?
Okay,
what you got coming up in the future for What the Finance?
Got a few interesting interviews coming up. Some of them are negative. One of them, Gregory Menarino, he talks about a lot about issues with the current system, what's happening. I feel like I have a bit of a mix of guess. Some of them are like everything's going to collapse, everyone's going to die.
Oh, I love that too. That's what I love. It seems like more have been on the collapse side of it lately, but
Yeah, and you can say that's
maybe those are just the better
yeah,
headlines.
exactly. It's always a challenge of headlines versus
Yeah.
actual information. So I have those ones, and I guess I get more of the institutional investors who are providing a bit more nuanced thoughts on maybe the short term, what's happening there. I've got a guy called Robert Bryce coming in, who's a energy expert, which would be interesting. So because I've talked to quite a lot of people who are thinking, Europe's going to collapse, they're going to run out of energy, but it hasn't happened. So it's like, yeah,
No, no, it seems like the energy prices were coming down too.
yeah, exactly. And you could say maybe it was an overreaction beforehand because everyone thought that was going to happen.
Mm-hmm.
But yeah, it sort of surprised me. And I'm not saying I thought that maybe I agreed with them, but I thought there'd probably be a bit more pain, especially in, you could say Europe and UK. But thankfully, it hasn't happened for my energy bill at least. And
Did you not see any huge prices for natural gas this year?
yeah, there was a big increase, but I'm lucky I have a small apartment, so
Ah,
but it probably went up like 3 times at least. So it was still like a bit pretty big, and like
it's still sucked.
yeah, and that was even with the government,
Right.
capping the price, if you can believe it. So yeah, it was quite bad. And then I'm talking to someone in a couple of weeks, Vincent Deluard, who's talking about why he thinks inflation will be higher for longer, which I guess is what we've talked about.
Yeah.
But he's talking about all the macro sort of risks that we're going to see in the future, deglobalization, sort of green energy transition, demographic risks, all those factors that for long term, it's sort of like a negative, it's like an inverse of what we saw from 1980 to 2020. Like the inverse is going to happen.
I got you.
Yeah. How about yourself? What have you got coming up?
Well, shit, I have to look. I got Eduardo Ibanez, the expert trader and CEO of Life Rewards. Kevin Davey, who I mentioned earlier. I can't wait to talk to him about rocket science. That'd be the first guest I've got to somehow work that into a trading podcast.
Yeah.
But I don't care because I love it. I want to hear more.
Rocket goes boom.
The guy I was supposed to talk to this week, Drew Spavetna, his house actually burned down. We had to reschedule it. That's why I reached out to you with the short turnaround.
Yeah, I heard that. I'm surprised he even messaged you to reschedule. Your legendary bloke.
I know, yeah, definitely getting him back on for that, just for that.
Yeah, literally.
I just I'm picturing him typing out the email standing on like the burning ashes of of his life, being like, sorry, man, can't make the podcast. I got to rebuild this.
That's a horrible thought.
A fucking legend, dude. You're a legend.
Yes.
Nothing phases Drew.
Yeah, definitely.
But yeah, that got that. Got more miniseries stuff that we're trying to work on. I got to do an options one here soon.
I'll have to listen to that. Yeah, as I said, I've got no insights into options, but I'm.
If you figure out currency trading, you'll have to help me put together one for that too. Maybe that'll be our next one after options.
Yeah, sounds good. I guess it depends on longer term time frames, or because
I'll give you a year to figure it out. Right? Should be able to have it done by then, right?
Yeah, exactly. Just free labor. Why not?
Yeah. What was interesting? You said.
Well, if you look at like what normally moves currencies, interest rates, inflation, sort of capital flows, balance of payments, balance of trade, etc. In the past 10 years, it hasn't really been that like there's been certain factors that have impacted it, but there hasn't been that much volatility. But last 2-3 years, there's obviously been lots of divergence between different countries. Like in the past,
Right.
like almost every country was like that either increase or decrease at a similar time to everyone else. Except for Europe. Europe didn't change for 10 years. Even Switzerland, they didn't change for 10 years. So it was quite easy not easy, but there's less volatility. There's less movement.
Right.
In the past 3 years, we've just seen ridiculous volatility, which is good for trading as long as you're on the right side of it. So, more potential money to be made. Yeah.
Yeah, but that's when your edges should get exacerbated. If you're looking for divergences and those types of things, those things become a lot more clear, right?
Yeah, exactly. That's sort of like what I was mentioning with the US dollar and why I think it would be go stronger in the short term at least. So yeah, it's pretty interesting, and I think it's almost the best way sometimes to get macro exposure. And you could say there's lots of other intricacies involved in it, but sometimes, it's a lot of times it's finding, and this might not be as relevant for day trading, but in swing trading, it's finding what influences a certain asset, and it's actually understanding that. So I think currency sometimes is the best way to understand, best way to hedge, not hedge, is to play sort of sometimes the economic and macro.
That's super interesting. Actually, I've got a roundtable recording coming up. I'm gonna actually bring that up with him.
Yeah, do it. And they might say that I'm completely wrong.
No, maybe. The whole premise behind it is like, why don't economists trade? So if this is a way that it actually sounds like it would make sense for an economist to try to take advantage of their knowledge, like, why aren't you even at least trying that?
Yeah, maybe they haven't. They just lost lots of money.
Maybe we'll see.
Oh, is that with Eric Mason? Was that one?
Yeah, Eric Mason and Eric Smolinski is coming back for that one.
Oh, nice.
He's the one who had the idea.
Yeah, that'd be really good. I think it's yeah, just having skin in the game. It's a lot harder to do that.
Mm-hmm. That also may be why they don't too, or partly why, because then you start introducing biases into yourself.
Yeah, exactly.
I think that was Andy Kramer I talked to about crypto and why she doesn't invest in crypto, because she wants to maintain her neutrality to it.
Yeah, I think that's bullshit. Sorry, I just think they
maybe
they try to make money off of other avenues, and they can't make it through investing.
Right.
Because if you think about it, the best way to do it should be through, if you have these views of investing. But yeah, I think I don't know. I won't say anything bad about economists. I think they do provide good insights, but they've been wrong a lot as well in the past, and they're very, it's easy for them just to flip flop or just to go on the same route without with no consequences. Basically, there's no consequences for them to be wrong.
I think part of the thing is that the field is just such a mess of probabilities that they can tell you what outcomes are more likely to happen, but it's just like weathermen trying to predict the weather. Anytime you're wrong, you're going to get shit on for it.
Yeah, true.
But nobody expects you to be right all the time anyway.
Yeah, I think there's an echo chamber as well, like of if everyone agrees on the same things, like like modern monetary theory or all these other factors, everyone has to agree on the same thing, and if you don't, you're sort of like a bit of pariah and an outcast,
or you're like Michael Burry and just screaming that the sky is falling for 10 years. Eventually you'll be right though.
Oh, yeah. Clock. What is it? A broken clock is right twice a day.
Yep. Even a blind squirrel finds a nut. All right. I think we should wrap this up. Let you get back to your Sunday.
Thank you, sir.
It's going to bring us to the end of today's episode. I'd like to say thank you to everyone for sticking around to the end, and Anthony for coming back.
No one stuck around to the end, did they?
Oh, no. I'm sure somebody did.
Is there anyone that's still listening? We had to.
If you'd like to hear more from Anthony, you can check out What the Finance on YouTube or your favorite podcast player. You can check us out at twobullsinachinashop.com. Back in your ears soon with another exciting episode. But until then, swat that 5-star rating like an ankle biter, chucking a wobbly, and take care.
What?
Did I get that right?
I don't even know. An ankle biter, did you say?
An ankle biter chucking a wobbly.
Wobbly, yeah, wobbly is a good one.
Okay.
I don't know what an ankle biter is though.
That's a toddler, a child.
Ah, yeah.
A kid throwing a tantrum.
Yeah, a wobbly.
That's what the internet said.
Wobbly is a tantrum. Yeah, I mustn't be Australian.
Okay, so I got something. You've been gone for too long. Damn it! I put a lot of work into that.
I'm sorry. It was great.
Rather than research topics.
I'll have to research next time. Fucking hell. just to get these analogies.
Yeah. All right, man.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.